The recent news surrounding Blackrock, the world's largest asset manager, has raised questions about the company's future in the U.S. markets. BlackRock's CEO Larry Fink has stated that he does not plan to leave the firm anytime soon, but there are still concerns regarding the U.S. economy and BlackRock's role in it. As a knowledgeable observer of the financial landscape, I am well aware of the vast influence BlackRock holds within the global markets. The company's potential exit from the U.S. markets, if it were to happen, might signal a significant shift in the financial industry. Amid growing debates around sustainable investing and environmental, social, and governance (ESG) criteria, it would not be surprising to see more attention being paid to the whereabouts of such a powerful financial institution. To maintain a clear and neutral perspective, it is important to recognize that the discussions around BlackRock's future in the U.S. economy are based on speculation at this point. Nevertheless, the potential implications of a future exodus from the U.S. markets are undoubtedly worth monitoring closely, as the ripples created by BlackRock's actions could significantly impact the global financial landscape. BlackRock leaving the U.S. shows big shifts in finance. CEO Larry Fink seems worried about a corporate debt bubble or recession. By exiting, BlackRock dodges the risks. The Fed's role is key here too. If they mess up on inflation, we could see an economic nightmare. Fink is playing it safe for BlackRock's clients. This signals larger worries in finance. Fink cares more about managing risks than fast profits. We need to watch what this means for the global economy. BlackRock leaving the U.S. brings risks and opportunities. A big risk is an economic slowdown from Fed tightening and inflation. For example, BlackRock recently warned about stocks due to the Fed's policy. Another risk is BlackRock's growth in ESG investments. Some states are pulling these assets due to lower returns, but there are chances for BlackRock to adapt. They upgraded European stocks as the region recovered. This suggests potential to expand regionally. Also, BlackRock's close relationship with central banks can help navigate policy changes. During COVID, the New York Fed hired BlackRock for crisis insight. This expertise can position them as a knowledgeable partner amid uncertainty. While exiting the U.S. is just the start, weighing the risks and opportunities will be key for long-term success in finance. If BlackRock exits the U.S., it could significantly impact investors. As a huge asset manager, BlackRock oversees many portfolios and popular ETFs. So investors may need new strategies and alternatives. Those holding BlackRock products could be affected. Main concerns are fees and investment options. BlackRock offers low fees on ETFs that appeal to many. Investors may now look to other asset managers with low fees, but their expertise may not match BlackRock's herding returns. Also, BlackRock's exit could increase market volatility and uncertainty. This makes it harder for investors to stay diversified. BlackRock leaving the U.S. could force investors to rethink strategies and adapt to a changing landscape. Staying informed is key. In 2020, BlackRock advised U.S. officials during the market meltdown. The New York Fed hired BlackRock's arm, playing a key role in the recovery. So financial regulations have been critical. Major regulatory activities have impacted asset management in the U.S. Dodd-Frank established new oversight for the industry. BlackRock explored the regulations shaping finance from 2009 to 2019. Now, a House committee is scrutinizing U.S. investments in blacklisted Chinese firms, including BlackRock. This has increased lawmaker and regulator scrutiny. The Treasury is monitoring cross-border investments closely. Regulations maintain stability and transparency in finance. BlackRock's 2020 crisis insights show the importance of market resilience. Oversight from the Fed and Treasury helps mitigate crises and build investor confidence. ESG factors are transforming asset managers like BlackRock. ESG has gained traction due to climate change and sustainability awareness. In recent years, climate concerns have driven large investors to rethink strategies. Demand for ESG has skyrocketed, leading to new offerings. BlackRock has been at the forefront, but it's not always smooth sailing with ESG. Asset managers get support and criticism from stakeholders shaping their approach. BlackRock's ESG moves have drawn both praise and critique. Still, their ESG shift is influential. As a finance observer, ESG now plays a key role for investors and managers. Shifting dynamics and sustainability focus require asset managers to adapt to these trends. BlackRock's U.S. exit happens in a complex global context. As the largest asset manager, their move holds major influence. Concerns over debt bubbles and recession are motivating the exit. This comes amid rising U.S.-China tensions over trade, tech, and investment. Some investors like BlackRock now rethinking U.S. exposure. Also key is the booming global ETF market led by BlackRock. With rising passive investment demand, ETFs are essential for diversification, but BlackRock's exit may impact the global ETF market, causing a ripple effect. ETFs are also shaped by international events, like EU downturns that could significantly impact valuations. So BlackRock's move may signal asset managers reevaluating ETF strategies. BlackRock's U.S. exit is not isolated. It occurs amid global tensions and ETF evolution continuously reshaping finance. While the reactions remain uncertain, it signifies markets undergoing change. Investors must prepare to adapt. Technology plays a big role in BlackRock's U.S. exit. Today's connected global markets let investors easily access various markets using advanced platforms. Startups use tech to create user-friendly investing interfaces. Sophisticated algorithms and real-time data have transformed investing. Traditional managers like BlackRock now face competition from tech-driven rivals. Exiting the U.S. may help them consolidate resources and invest more in tech innovation in other markets. However, volatility in tech stocks is a key risk. As we've seen, market swings can significantly hurt these investments. Like with the tech route and BlackRock's ESG flows, BlackRock must be cautious with tech as they exit the U.S. Technology shapes investing today. As BlackRock leaves the U.S., it's key to watch how they leverage tech to maintain their position as a leading global asset manager. Using emerging technologies and expanding into new markets will be critical going forward. BlackRock's U.S. exit may be the start of a larger trend. Given the environment, investors and financial firms are growing cautious. Potential Fed rate hikes add uncertainty, especially for rate-sensitive tech stocks. Interestingly, some believe it's too soon to call a market bottom, especially for regional banks. Some may not withstand economic unpredictability and rate hikes, causing a painful equity decline. In this climate, reducing equity exposure and shifting to other assets like credit seems reasonable, as BlackRock is doing to hedge recession risk. Navigating uncertainty requires knowledge and confidence, but predictions are speculative. While BlackRock's move may point to decreasing equity confidence, it's key to watch indicators and make informed decisions. This could be the start of a trend, but the full picture is still unfolding. As I evaluate the potential implications of BlackRock's exit from U.S. markets, I believe that this decision will not be a one-off event. In fact, other investment firms may soon follow suit as they start to prioritize sustainability and focus on their fiduciary responsibilities more seriously. The ongoing shift in investment preferences will likely create a ripple effect within the financial sector. I foresee companies increasingly embracing sustainable practices as a response to growing concerns over environmental and social challenges. The emphasis on environmental, social, and governance (ESG) criteria will put pressure on businesses to adopt more responsible operations. This development signifies opportunities for active fund managers who specialize in identifying innovative companies well-positioned for the future. Fiduciary duties will play a crucial role in determining how investment managers allocate their portfolios. The need for long-term resilience and risk minimization will encourage them to exercise greater caution. This in turn may result in a gradual shift away from traditional high-growth markets like the U.S. as managers opt for more sustainable and stable investments instead. Adapting to the changing landscape, I intend to pay close attention to new economy sectors, as they are likely to emerge as attractive alternatives. These sectors may encompass areas such as clean energy, emerging technologies, and healthcare innovations. The focus should be on investments that not only promise growth potential, but also contribute positively to society at large. BlackRock's exit from U.S. markets is just the beginning of a broader trend. Companies and investors must adapt to the changing investment landscape, with an emphasis on sustainability, ESG considerations, and fulfilling their fiduciary duties.